In this video, I'll tell you everything you need to know about mutual funds and how to invest in them. And we're starting right now. Hey everyone, Elliot here. We need to talk about mutual funds. They're a hugely important investing tool, and in fact, one could say mutual funds and index funds are the cornerstone of all equity investing, and it's a good idea to learn everything you can about them. So first off, what exactly is a mutual fund? It's nothing more than a pool of money from many investors that is used to purchase securities such as stocks. So as you probably noticed, this is kind of opposite of picking out and buying individual stocks yourself. You're now giving money to the mutual fund and it will buy the stocks for you. Now why would you do this? Well, for starters, a mutual fund may be managed by someone who is, in theory anyway, far better than you at picking stocks. The second reason may be that you just don't want to or don't have the time to do your own research and pick stocks, but you still want to invest in some way. Mutual funds make this easy. You just pick a few top-rated or top-performing mutual funds, buy some shares, and let the pros do the work for you. Finally, mutual funds allow you to diversify and hold a wide variety of stocks or hold certain types of stocks that best match your goals or even personal philosophy. If you want to invest in clean energy, for example, there are mutual funds just for that, and you don't need to research and buy dozens of individual stocks yourself. There are also special types of mutual funds called index funds that hold the same stocks as one of the stock market indices, and last week I dedicated an entire video just to them. Now, mutual funds are a pretty simple idea, and in theory, anyone can actually set up and run one, and why don't we demonstrate this right now as an example? Let's say you know a guy named Dave, and Dave is a big techie. He knows every piece of audio gear, computer gear, gadgets, and even runs a blog that reviews all sorts of high-tech equipment. Let's say he gets this idea that because he knows these tech companies and their products so well, he will start up a mutual fund that only invests in these companies. He convinces 20 of his friends to give him $1,000 each and then uses the $20,000 to buy a few shares of stock from each of the 30 or so tech companies that he knows really well, and he calls it Dave's Awesome Tech Fund. All his friends in turn buy up shares of the Awesome Tech Fund and pay a service fee because Dave decides he will need to pocket 2% or $400 for his efforts in managing the fund. And so it went. Dave would keep an eye on the tech stocks in his fund and select new ones occasionally to replace older ones that weren't performing. His fund did really well since he picked good companies and all the shares rose in value. Word of the fund spread, and the following year another 10 friends decided to join in with $1,000 apiece. The fund has now grown to $30,000 of initial investment and also went up $10,000 in capital appreciation and is now worth $40,000. Dave, of course, is pretty happy. He now gets to keep $800 for his efforts since that is 2% of $40,000. The fund grows year after year and becomes well known as more people join in. This really simplified example is essentially how a mutual fund is created and operated, except of course instead of techie Dave, we have a financial corporation which hires a professional manager and a team of analysts, and instead of 30 of his friends, we have tens of thousands of investors putting in millions of dollars. So hopefully with that little story about Dave and his fund, you now have a pretty solid idea of what mutual funds are. Let's now go over some really important additional info about them, starting with the way the mutual funds can be categorized. By far, the most important distinction you can make is whether a mutual fund is actively managed or passively managed. An actively managed fund is exactly what Dave's fund was. There's a manager or a team of managers and analysts, and they pick top performing stocks to add to the fund and remove the poorly performing ones. These funds are typically pretty aggressive, and their goal is to beat the market, and in other words, provide higher returns than the market average. The upside here, of course, is that in the right hands, the fund can give you some impressive returns. The downside is that the fund manager could be wrong and pick too many losers and not enough winners. In either case, there will be a percentage fee charged, so managed funds can also be quite expensive. A passively managed fund has no management fees. So how do stocks get picked and managed then? Well, they don't get picked or managed at all. Passive funds, by definition, are index funds that automatically invest in exactly the same stocks and the same proportion as the stock market index they are tied to. This index is usually the S&P 500, but it can be in the NASDAQ, the Dow, or others. So there's virtually no management needed with these, and index funds are super cheap to operate with the savings passed on to the investors. As I mentioned earlier, index funds are an important enough topic for its own video, which I'll link to in the description below. For the rest of this video, we'll just talk about actively managed mutual funds. The next really important topic to know about with mutual funds are those costs and expenses I mentioned earlier. There are two types of fees fees that an actively managed mutual fund has. First is the transactional fee or load. That fee is imposed when you buy and sell shares of the fund. Second, you have the annual ongoing management fee, also called the expense ratio. So the first item, the buy or sell transaction fee or load, is just another name for a commission and is paid out by the fund to the broker and other marketers. When you hear a fund referred to as no load, this simply means there's no fee to purchase shares of the fund, and that's something that's certainly a big plus. A lot of funds do have loads, however, and you should be aware of two types. The first type is a front-end load. This is the more commonly found load, and it charges you up front to purchase shares of the mutual fund, usually a one-time fee regardless of size of purchase. It is expressed as a percentage, that is $10,000 invested all at once, with a 5% load is equal to $9,500 actually invested and a $500 fee. The second type is the back-end load. As you would expect, these are fees to sell the mutual fund shares. They can get a bit more complex, however. In order to incentivize investors to buy and hold, the back-end costs may diminish progressively, say from 6% in the first year to 0 by the 6th year of holding the shares. So a typical fund may have a combination of both front and back-end loads, with the back-end ones phased out after some time. The second fee is of course the money you have to pay the management team for what is hopefully effective and skilled management of your fund. This management expense ratio is taken out of the fund's market returns, so investors pay for it indirectly by earning less on their investment. Also in there are a variety of administrative and marketing fees that the fund needs to operate. In total, all these expenses and fees can be upwards of 2% of the fund total, which is certainly an astronomical amount of money if, let's say, we're talking about a $10 billion fund. Passive index funds, of course, have much lower fees, which can get as low as 0.02%. Now, if you're saying, that's a lot of fees I'm being charged, can I get a break on the cost here? Well, you can, especially if you're planning on investing a sizable amount of money. The mutual fund world, it turns out, is not much different from Costco. You save more if you buy in bulk. There's something called break points or tiered price points where you get a discount on the load fees charged. Where those points are depends on the fund, but they can be in steps of 5,000 or 10,000. You also have something called the right of accumulation, where you can accumulate purchase shares of the fund and hit these price points over time and catch a break on the fees. There is even something called a letter of intent or LOI, where you promise in writing to buy a certain number of shares and you will be given a price break right away, which of course can be rescinded if you fail to live up to your end of the agreement. Now, admittedly, maybe you won't get that much out of these savings if you're a very small investor, but you certainly will if you have deeper pockets to invest with. Okay, so you should now have a good handle on the two distinct categories of funds and understand some of the fees and price breaks involved with the actively managed ones. Next question is, what type of funds are out there? Here the sky's really the limit, as there are just as many mutual funds as there are investing opportunities. There are numerous stock funds that focus on growth, income, and value stocks, or invest by categories such as by sector, industry, or philosophy, such as the previously mentioned green energy. On the flip side, there is even something called vice funds that invest only in tobacco, alcohol, and casino stocks. So really, whatever approach or area of the economy you wish to be part of, there's a mutual fund to take you there. There are also mutual funds that invest in bonds, and they have many more categories within them, such as municipal bond funds, government bond funds, corporate bond funds, and many others. There are still more mutual funds that specialize in international stocks, precious metals, commodities, mortgage-based securities, and many more categories that we could spend hours talking about. So how big is the mutual fund world, and how do you get started investing in it? Well, let's answer the first part. There is over 66 trillion, that's trillion with a T, invested in mutual funds around the world, with over 138,000 mutual funds in existence. Here in the US, there's over 22 trillion invested and about 6,500 funds available. Some of the biggest mutual and index fund companies out there include many that you may have heard of, like Vanguard, Fidelity, BlackRock, T. Rowe Price, Dreyfus, and many others. If you want to start investing in mutual funds, you need to do your research and focus on two key items. Check the historical returns of the mutual fund for 1 year, 3 years, 5 years, and 10 years. Then check on the expenses such as the loads and the management expense ratio. You will of course want to pick the best performing fund, but with the lowest expenses. You're not likely to find the perfect fund, but do your best to find a compromise between the two. Keep in mind a very important point, and that is that higher fees do not necessarily correspond to better returns. Let me actually repeat that again in big bold red letters.
Higher fees do not necessarily correspond to better returns.
When you pick out a fund that interests you, but before you commit your money, be sure to read something called the prospectus. This document is mandated by law and spells out every detail of the fund and its investment approach. Okay, so to close out this video, let's take a quick look at a typical managed mutual fund. The one I picked to show you is from Fidelity, and it's called the Select Consumer consumer staples portfolio with a ticker symbol of FDFAX. It's a very typical consumer defensive fund and a good representative to take a look at. Here it is viewed through the TD Ameritrade interface. As you can see right here, each share of the fund costs about $93 as of the filming of this video, and it is a no-load fund, so it won't cost you anything to buy in, which is always a positive. It has a fairly typical gross net expense ratio of 0.73, which means it will cost you $7.30 in fees for every $1,000 you invest, or $73 for a $10,000 investment. Taking a look at the fund's portfolio, you can see it's made up of 51 stocks as determined by the fund manager and analyst, and the top 10 holdings are listed right here. You also have insight into some of the fundamental analysis metrics such as the PE ratio as well as the price book and the dividend yield. You can of course see all the holdings if you wish, and they are about what you'd expect in this type of fund with Procter & Gamble, Coca-Cola, Walmart, and other such consumer staples companies. Finally, let's take a look at the fund's performance, which I took from Fidelity's site since I felt their graphics were better. The fund's chart is shown here in purple, and it's not terribly impressive when compared to the S&P 500 shown in blue, with the fund often underperforming it when viewed through the 5-year and 10-year benchmark time spans. This actually isn't very surprising since these are defensive stocks that tend to stand out in a down economy, and we've had a very booming economy in the last 15 years, so a fund that invests in non-defensive stocks would have certainly done better and would have been a better choice to invest in if you wanted aggressive returns. So this particular fund was just an example. I'm in no way suggesting you invest in it, and merely wanted to show you what to look for and how to do some very basic analysis. As you can see, a fund manager did all the stock picking, and you just need to see if the historical results prove them to be good at what they do, and thereby deciding if you wanted to buy in or skip it and research another fund. Okay, so that was a quick primer on the fundamentals of mutual funds, and hopefully you now have a better understanding of some of its terminology and concepts of mutual fund investing. As always, be sure to subscribe and hit that like button, and also let me know in the comments below what topics you would like to see me discuss in detail. Thanks for watching, and I'll see you all soon.